The markets are on a bullish run that is truly unprecedented. We have seen a rally of over 50% in just a few months with an underlying economy similar to the Great Depression. Now, at Game of Trades, we are expecting a big deleveraging in the markets over the next couple of years. But before this, we are going to see incredible gains in the final run to the top. Gains probably very similar to what we have seen on this rally so far. We have been very bullish on the market since they broke out of that 61.8 retracement level and went on this parabolic run. We bought the dip heavily on divergences here, and we have so far aimed for all-time highs before the next big correction. So this video is very important to understand for anyone who is trying to short this rally. We are going to go through 3 key points on why the markets will enter a parabolic phase to the top of the 2009 to 2020 bull market. Of course, we do not have a crystal ball. We have been right before, we have been wrong before, so make your own research before investing. This is how we are basing our trading. This is how we are basing our investments at Game of Trades. And of course, all these crazy moves that we have been seeing and that we will continue to see is not great for your investments. So we are very, very heavy in other asset classes like gold, like silver, commodities, and cryptocurrencies. So point number 1, the market is more bearish than ever in a recovering economy. Just look at how many investors are bearish. Almost 50% of investors are bearish on the markets. Now, yes, I know what the comments are going to say. The economy has never been so damaged, so this kind of figure is justified. I mean, just look at this drop in GDP. This is absolutely crazy. This is a worse drop than we saw during the Great Depression. We do not like doom and gloom on this channel, but you do need to face the facts when you get numbers like these. The markets are way overvalued, and surely the markets should be in proportion to this drop. If we want the GDP and the markets to be similar, we would need to see a recovering GDP with 30% gain in GDP over the next 2 quarters, which is just not something we are going to see. But putting all of this aside, the fact is that the economy is getting better. The unemployment rate peaked in April, and so far we have been recovering. So this is going to continue to be the trend over the next few months. And the number of cases has also probably peaked for a few months. The last time we peaked was over here. It took many months before the number of cases started to pick up again. And this is probably going to be a similar scenario. We are going to see a decreasing number of cases over the next few weeks to few months. So all of this is good news, and we're going to continue getting good news on the economy. The market looks forward, not backwards. So having such a bearish number, almost 50%, with improving economic data is very impressive. Nobody thinks we can go higher, and yet the markets continue to go higher. And we can look at a graph to show how this sentiment has changed over the past few months. You can see the green line is the bearish sentiment, and the orange line right here is the bullish sentiment. And you can see the gap between bearish and bullish has never been wider. We are at extreme bearish sentiment, and we have been for weeks. And you can see the last time we had such a gap this wide was right here, May 7th. And we can look at the stock market, what happened right here. This was the 7th of May right here. This was right before a big breakout in the markets right there. A parabolic breakout. And we talked about having the exact same scenario on a breakout out of this trading range. And this is exactly what's happening. We are having extreme bearish sentiment right here, right before a big breakout of this consolidation range and out to all-time highs. Now, don't get me wrong, we will correct at one point, probably at the 3,400 point level, because the put call ratio is just going to get extremely bullish. But we do think we have some room to go, maybe a slight correction before another leg up. So going back to the investor sentiment, why does it work this way? I get a lot of people asking me in the comments, why is it that when most people are bearish, it actually pushes the markets up? And I like to see this, the bearish number, as potential growth. If that number starts to go down, if it goes down to 40% and then 30%, that means that all those investors have turned to bullish. And so this number is going to start going up, and that means more people are starting to invest in stocks, more people are bullish, and that starts to push stocks higher. A great example of that would be a YouTube channel that starts posting a lot of great content, and so people start liking the videos, and that pushes the channel to a larger audience. So if you enjoyed this video so far, make sure to drop a like on this video so we can get a little bit of that bullish sentiment on the channel. Now let's move on to the second point that is going to push the markets higher. And this one is often overlooked by investors, but it is the liquidity. And we found a great chart from mcoscillators.com illustrating this. And you can see this is M2, the red line is M2, so the amount of money in the markets divided by GDP. So it is in proportion to the size of the economy. And you can see every time we have a surge in M2, there is a surge in price. That happened in 2001. That happened in 2009 right here. And that is likely to happen again now. The surge in price we have seen is incredibly small compared to the amount of liquidity that we have gotten. And there's a little note here on the side that says it assumes another 4% GDP drop in Q2. And as we saw earlier, we got a 30% drop in GDP in Q2. So this ratio would zoom even more. So this red line right here actually goes off this chart. And that's not even to mention the second stimulus package that will be coming in the coming weeks. We're likely going to be at all-time highs when we get that stimulus package. So this really has the potential to trigger some big moves in the markets. And that brings me on to my next and final point. And I'm going to clear the chart before I do so. We are getting such a big surge in liquidity so close to all-time highs. So what do I mean by this? You can see that every big surge was following a big bear market. So we had a huge bear market in 2000 right here, and we got the surge in liquidity around the bottom of that. Same thing in 2008, we had an almost 60% drop in the markets, and we got the surge in liquidity at the bottom of that. In 2020, we only had a 30% drop in the markets with an even bigger response than before. So we are already at all-time highs. And again, not to mention the second stimulus package that will likely be coming in the next couple of weeks. So this is something that we actually have never seen before, getting such a huge amount of liquidity at all-time highs with absolutely no resistance in the markets to block the price from going higher. We think that can actually be the trigger for those parabolic moves in the markets over the next couple of weeks, couple of months. In fact, we do have a small example, but a very small example here in 2015. We had a small surge in liquidity right here, but obviously nothing compared to what we're seeing right now. And we did end up getting a parabolic move. If we look at the stock market here in 2017, this is the parabolic move that we got into the top of 2017. So the surge in liquidity that we have gotten now will likely trigger moves like this, but in much bigger proportions. So again, I think the combination of extreme bearish sentiment accompanied with huge liquidity in the markets being injected at all-time highs is going to be the perfect storm for the markets to be on a parabolic move into a blow-off top scenario before ending the 11-year bull market that we have seen since 2009, and actually end the full cycle that we have seen for the past 40 years. And if you're wondering what I'm talking about, go and check out our last video where I discuss the disinflation cycle that we've seen since the 1980s that has really been the main trigger behind rising stock prices consistently for 40 years. That's likely going to come to an end over the next couple of years. So that's about all I wanted to cover in this video. If you're interested in checking out the charting platform we use, you can click the link in the description below. I hope you guys enjoyed this video. If you did, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.